This week, Deutsche Bank did something strange. It gave away every savings account, every personal loan, every retail customer it had in India, sold the whole lot to Kotak for about $30 million, and then, in the same breath, called India a core market it's committed to. Here's the number that makes it stranger. Even after this sale, more than a quarter of Deutsche Bank's entire global workforce sits in India. Tens of thousands of people. Soon, not a single one of them will open a savings account for you. So, what do they all actually do? It turns out your mental picture of a bank, branch, deposits, loans is the smallest, least profitable corner of what a global bank really is. Today, we open up the invisible bank, the businesses you never see that move more money than the ones you do. To understand the invisible bank, you need one idea. Banking is really two completely different games. Retail banking is a volume game. Millions of customers, tiny margins on each, and to win, you need thousands of branches, decades of local trust, and seamless digital payments. That's a game India's domestic giants have already won, which is exactly why Citi sold its retail arm in 2022, Standard Chartered trimmed in 2023, and Deutsche just followed in 2026. A foreign bank with 17 branches was never going to out-branch, out-trust, or out-UPI them. But everything else a bank does is a different game entirely, an expertise and network game. Few clients, complex problems, fat fees. And the winner isn't whoever has the most branches, it's whoever has the deepest specialists and offices in the most countries. That's the game a global bank is built for. Let's walk through it, business by business. Start with the closest cousin to what you know. Corporate banking is lending, but to companies instead of people. When a manufacturer needs money to buy raw materials before it gets paid for finished goods, that's working capital. When an infrastructure firm needs hundreds of crores for a project that pays back over 15 years, that's project finance. The loans are bigger, the relationships run for decades, and one corporate client can be worth more than an entire branch full of retail customers. And foreign banks bring something specific here: hard currency muscle and appetite for complex risk. Deutsche, for instance, lends to Indian corporates in both rupees and foreign currency, and by its own account pioneered India's first distressed debt financing for a large corporate. The kind of rescue lending that helped the client restart operations within 2 months. Not the stuff of branch posters, very much the stuff of banking. Next, investment banking. The business Hollywood thinks is the whole bank. Investment bankers don't primarily lend money, they sell brains. When one company wants to buy another, the investment bank advises. What's the target worth, how to structure it, how to finance it. When a company wants to go public or raise debt, the bank runs the process, pricing the shares or bonds, finding the buyers, underwriting the risk. Notice what's beautiful about this business from the bank's point of view? It's mostly fees. Advice doesn't tie up a balance sheet the way a million home loans do. A handful of bankers on one large merger can earn what a retail network earns in a year, which is exactly why a bank retreating from branch doesn't dream of retreating from deals. Now the engine room, markets, trading currencies, interest rates, and derivatives. It sounds like gambling. Most of it is the opposite. It's selling insurance against uncertainty. Take a real everyday Indian problem. An IT company earns in dollars but pays salaries in rupees. If the rupee strengthens before its dollars arrive, its profits shrink through no fault of its own. So it goes to a bank's market desk and locks in today's exchange rate for a future date, a hedge. The company sleeps, the bank earns a spread for carrying that risk. Multiply that across exporters, importers, airlines hedging fuel, and companies hedging interest rates on their loans. And you get a business that runs on maths, technology, and global flow. Rates, listed derivatives, electronic trading. This is also precisely where a global bank's network pays off. Risk taken in Mumbai can be offset in London or Singapore within seconds. One honest footnote: markets desks don't only hedge for clients. Banks have historically also traded for their own profit, and that's the part that burned the world in 2008. Regulators have since fenced it in hard, which is why the modern markets business leans back towards its boring, useful core, selling certainty to companies that need it. Here's the business almost nobody outside finance can name, and it may be the most important one: transaction banking, the plumbing of global commerce. Three pipes: cash management. A multinational with operations in 40 countries needs its market swept, pooled and moved across borders every single day. The bank runs that circulatory system. Trade finance. When an Indian exporter ships goods to a stranger in Germany, neither side wants to pay first. The bank stands in the middle with instruments like letters of credit guaranteeing each side against the other. This is centuries old and world trade literally doesn't move without it. And the third pipe matters most for India custody. When a foreign pension fund buys Indian shares, someone regulated and trusted must actually hold those securities, settle the trades, handle the paperwork with Indian regulators. Global banks like Deutsche are among the leading custodians by its own description, a leading provider of access for foreign investors into India. Every headline about foreign money flowing into the Indian market rides through pipes like these. Notice why this business is so sticky. A pension fund managing other people's retirements will not hand its assets to just anyone. Custody runs on reputation, regulation, and decades of flawless plumbing, which is why the same few global names keep it, and why it quietly compounds while nobody watches. And here's the next one. What about rich individuals? Didn't Deutsche just sell its wealth business? Here's the telling detail. It sold the Onshore India Wealth Unit and explicitly kept serving global ultra high net worth clients, including non resident Indians from outside India. That's private banking's real logic. For the wealthiest families, banking isn't a branch relationship, it's a cross border one investments, lending, and structures spanning multiple countries. A global bank's edge is precisely that span. The middle of the wealth market went to Kotak, the global top end never left. Add one more quiet outpost Gift City, India's offshore financial center where Deutsche runs an international banking unit, booking the kind of cross border business that once had to route through Singapore or Dubai. The bank left your neighborhood, it did not leave the country's financial map. And now the part that explains the headcount, because branches never did. The single biggest reason a quarter of Deutsche Bank's global workforce is in India is this. India runs the bank's back office for the entire planet. Its global services arm, thousands upon thousands of people in Mumbai, Pune, Bangalore, and Jaipur, processes operations, builds technology, runs risk, finance, legal, and compliance functions for Deutsche Bank worldwide. When a trade settles in Frankfurt or a system runs in New York, the odds are good someone in Pune built or checks it. It goes further up the food chain than the back office suggests. A Mumbai center of over 1,000 quants and analysts does front office work, financial modeling, structuring, research for the bank's clients globally. This is India's famous GCC story, Global Capability Centers, playing out inside a bank. India stopped being just a market Deutsche sells to and became infrastructure the bank runs on. You can sell a retail unit, you cannot sell your own nervous system. So, the honest scorecard. What does India get from the invisible banks like this? Real things. Hard currency lending and complex financial domestic banks are slower to touch. The plumbing that lets foreign investments flow in, global standard expertise, and through the services arms, hundreds of thousands of high skilled jobs across the country. What's the catch? The invisible bank serves companies and institutions, not you. As global banks abandon retail, the ordinary customer's choices narrow to domestic players. Less competition can mean less pressure on pricing and innovation over time. And there's a more subtle dependence. These banks are here because India is winning. They concentrate where returns are. If that math's changed, so would they. Neither cheer nor alarm then, just clarity. The foreign banks didn't leave India. They redrew their map of it, keeping every business where being global is the advantage and conceding the one where being local is. So the next time the headline says a foreign bank is leaving India, you'll know the better question. Which game is it leaving and which is it quietly doubling down on? Because behind every branch you can see, there's an invisible bank you can't. Lending to the factory, advising the merger, hedging the exporters, selling foreign funds trades, and increasingly running the whole machine from Mumbai, Pune, and Bangalore. The branch was never the bank. It was just the only part they showed you.